Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, Annuity Income Options, part 4 in our series on annuity retirement strategies. Now we're in segment 4. When we talk about annuity income options, there are a lot of ways to go here. What are your options are, and we're going to go through some of the top 7 options that you can look at as a payout, and it depends upon what you want to do. Remember, there's always pros and cons to every selection that we're going to deal with. You have to figure out what is suitable for you. Is this payout suitable to match up to your goals, your time horizon, your risk tolerance? I'm always thinking about this. There's multi-dimensional thinking here when you're talking about retirement. It's not just set it and forget it. That's not going to happen. So I want to look at this idea of how this works, and let's just look at the first one. I have a life annuity. It's based on the contract value, your age when the payments begin, and the interest rate if it's fixed. Now think about this. I'm going to get a life annuity. That means that as long as I'm alive, it's going to pay. What happens though if I walk out 30 days later after putting this contract in force? I have a lifetime guarantee and I were to somehow, God forbid, have a car accident and I died. Well, that number, that single premium annuity would be gone. Or that deferred income annuity would be gone if it was lifetime. So I might want to look at a cash refund or an installment refund. Now that brings the rate that I'm going to have for my income down a little bit because I'm actually buying a privilege so that if I didn't get all my income back or all the money I spent, it's going to my beneficiaries either in the cash or paying it in installments to my beneficiaries. So it's a great idea, but if you're saying, boy, I don't like that idea of this, something happening, you might want to look at that as an alternative. Life annuity, and remember, we're living longer. Longevity risk is huge in retirement in the United States right now. We're all living longer. Lifetime annuity, that could be a play for you. That coupled with Social Security will give you 2 sources of income that would be guaranteed for life. I like that idea. Another one is life income with period or term certain. So let's say, and I've seen this before, you look at a person that says, hey, I think 30 years is a pretty good number for me to look at my retirement. I'm retiring at 70. I can't really see myself living past age 100. I'm going to look at the life annuity rate, but sometimes, and this is why you have to check it just before you make your purchase, sometimes I've seen 30-year certain rates a little higher and a little bit better, and if my longevity or my life expectancy is going to be close to that number, I might choose the actual 30-year certain over the lifetime. Remember, you have to know what you're getting yourself into. Uh-oh, you live till 105. Remember, that period certain is gone already. You spent it in 30 years, or you used it in somehow. So remember, it's a great idea. I want to know what your longevity in your family is, what your health is today, and is the rate that I get on the 30 that much better that I'm willing to take it and risk not living that much longer. It's a good idea, and remember, whatever you don't use, your beneficiaries are going to get it. So I love that. It's based on the contract value, your age when payments begin, and the interest rate if it's in fixed income. So you want to look at this number. I always want to look at time period certain. It could be 5 years. It could be 10 years. You could lock down for 15, 20. It'll give you a guaranteed number that you can bank. It's contractually guaranteed, and that's the number you're going to have. And remember, some people sometimes have buyer's remorse when they buy fixed annuities. Some annuity carriers will let you out of the contract. They'll figure out what you've already taken constructive receipt on. They'll take a little bit off of the top. It's kind of like, hey, they have their own problems matching up to their assets, so you're going to get a little bit less, but there's liquidity there. And a lot of times, that little exchange may not be anywhere near the cost of a surrender charge. It's just a possibility as another option. One of the other ones is life income with refund payment. So as I said before, I want to take life income for my annuity, and I want to take it out forever. But I want to have a refund option so that if I died, or my wife, if we were holding it joint and we both died, and we died before we collected our original principal, we want to be able to have a refund payout option. So based on the contract value and your age, your payments will begin, and the interest rate, and they'll give you a refund guarantee. They'll tell you whatever it is, we'll pick up the difference. Do you want us to give it cash to your beneficiaries, or do you want us to give it in an installment? I can only speak for myself. Sometimes I like to give installments to the next generation. I don't want to give them a lump sum in cash. They're still going to get it. It's just going to be spread out, and they can be more judicious and use it in their budget in a good way. I'm just afraid that if they get a lump sum, hey, they're going to buy a new Corvette. Now, another one, joint and survivor life annuity. Again, I can put two of us on one contract. And by the way, qualified plans, even though they might be two separate, I could actually put my spouse on mine. So you need to look at the math, which one's going to deliver and generate the higher the income in a qualified plan. So I can put us both on together. Now, when I do myself, and let's say you had husband and wife and they were the same age, you'll notice that the husband gets a little bit more payout because his life expectancy is supposed to be shorter. So if the life expectancy is shorter, his payout is greater. The female equivalent, if it's the same age, she won't get as much because they think she's going to live longer, so they'll have to make payouts together. So first one is male. That's the most money. The second one is female on a deal like this. But then people say, let's do it together. Put them on the same. So they're going to split the difference. The actuaries are going to sit down and look at that number and that payout, and they're going to pay you what it is for a joint survivor. They're going to figure out how long the wife is going to live. Now, I saw an article in the Wall Street Journal that said the average male in America is going to be living to 88.8 years. I'm sorry, 86.6 years. And the average female is 88.8 years. And the survivor of a marriage, generally the female, 87% of the time, is going to live till 93. So I started using the minimum number, unless I got some real serious longevity crimps, like maybe I have congenital disease that's passed down from one family to another. We don't live long. But for the vast majority of us, if the average female out of a marriage is going to live till 93, that means that half of American females are going to live beyond that. So lifetime income on a joint is going to be very, very important. And I like that ability to have it. So if I die or my wife dies, one of us, we're always going to get that number. And people like that in planning. They like the idea of certainty. And then there's joint and survivor annuity with period or term. So now I'm taking joint survivor, my wife and myself. It could be myself and my grandchild, myself and my son. It can be two people can be the annuitant. Just to figures out how it works for you. Remember, ownership here is going to be the tax issue, and who's on the annuity is going to be the way we schedule the payouts. So joint and survivor annuity, period or term certain. Let's say we picked a 30-year certain term, and I put both my wife and myself on it. They're going to calculate that, and they're going to say, okay, we're going to go joint and survivor annuity. I'm going to have my guaranteed life, but I'm also going to have a guaranteed amount coming to me or my spouse or my beneficiaries guaranteed. I have a lifetime income annuity, but I also have a period certain that it's going to pay no matter what. So you want to look at that. That could be a place, because people feel like they want a little bit of comfort here in case some worst scenario actually occurs. And fixed amount is available only with fixed income payouts. You say how much you want. So if you say to me, Steve, I've looked at my Social Security. I know what my income for myself and my wife is. We've already established it. So you set it aside. Then you say, but my budget with my discretionary and essential spending is actually greater than that. So I'm going to pick up an annuity to make up the difference. So if I say I need $1,500 more above and beyond what I'm getting on my monthly Social Security, I'm going to figure out what is the lump sum I need to generate $1,500 so that my Social Security and my annuity payout pick up all my essential spending in retirement and discretionary spending in my retirement. So that's all I'm using it for. I don't use annuities for anything else, honestly. So I look at those two ideas, and I'm looking at income, guaranteed income, that'll take care of my guaranteed obligations. And then the last one, fixed period. Again, some people want to look at a fixed period income. I love them because while I'm accumulating, I think right now, the annuity 5-year rate, 4-year rate, 3-year rate's beating the traditional CD rates. Again, I want you to go out and do your due diligence. Look at bankrate.com. Look at the 3, 4, and 5-year rate. I wouldn't go beyond that. And then look at the annuity rates that are out there published, the guaranteed rate, not the ones that can change, but the actual guaranteed. So I want a 3, 4, and 5-year. I'm going to look at that rate at the end of the 5-year period. If I don't need the income, I'm going to go shopping again. I might be looking at 3, 4, and 5-year again in increments. Keep them small so I can be flexible. So right now I have a 5-year rate, and I'm also now I have some annuities that are 5 years done. I'm going to actually do a 3-year rate because it's so close to the one I bought the 5. So I'll have a little bit of 3, a little bit of 5, and I still have all my mutual funds and ETFs in the marketplace, participating, in my view, one of the greatest market moves in 2017. It's been huge. So you want to look at these things and look at your income and why you're buying it. So you have these options. Now I want to show you basically your strategies. Annuity strategies, when you're using this, again, you have to figure what are your factors? How long are you going to live? How much money you're going to take? Is it going to be joint survivor, single, period certain, or lifetime? Once you make these decisions, then you can look at the math and put them into your time horizons, put them into your budget, and match up your income needs against your expense needs in retirement. And don't forget to watch our next segment, Purchasing Blocks of Retirement Income, Part 5 in our series on Annuity Retirement Strategies. And keep in mind, before moving forward with any of the ideas on the show, always check with your tax consultant, legal counsel, and financial advisor. You've been watching Steve Savant's Money, the name of the game.